Nikkei 225 just ripped through 65,000 like it was nothing. A 3% single-day firework that left every seller gasping. But before you hit the buy button with both fists, ask yourself one question. Is this a genuine melt-up into a new regime, or the most beautifully engineered bull trap we've seen since the last Bank of Japan intervention shock? Because right now, sitting at 65,158, the index is flashing a full table strong buy on every single time frame. Monthly, weekly, daily, 1 hour, 5 hour. And that is precisely the moment when the market begins to hunt the herd. There is one danger zone and one hidden opportunity today. I'll show you both. Stay until the end. I'm giving out 3 exact entry and exit levels you can use right now, whether this rips another 1,000 points or reverses 4 figures in an afternoon. Here's the instant market verdict. The session bias is trending, but the trend is so overstretched that it carries a momentum trap signature. The dominant structure is a breakout above the 64,087 resistance cluster, and that breakout is absolutely genuine, volume-backed, closing above the level, no wick rejection. That turns 64,087 to 64,043 into the first support zone. But the invalidation level that proves me wrong and shifts the entire structure from trend to fade is 63,940. 6. Write this number down. 63,946. That's the first key support printed on your sheet. If the Nikkei trades below that level on a 4-hour closing basis, the breakout is false and we are looking at a liquidity trap that will accelerate to the downside. If it holds, the trend is intact and every dip is a buying opportunity. So mark 63,946. I'll come back to it. Now let's walk the charts top down, because this is where the edge lives. On the monthly chart, the Nikkei is in a structural strong buy with price accelerating away from the 20-month moving average at 59,609, the 50-month at 56,959, and the 200-month at 53,051. That's a staircase of support 120 points wide, and the slope is steepening. We haven't seen this kind of monthly momentum extension since the post-Abe era repricing. The monthly MACD histogram is expanding with no divergence, and the RSI at 68.5 is above the bull market threshold but not yet at extreme euphoria on that time frame. So the big money is still positioned long. However, when we drop to the weekly, the picture stays strong buy but the RSI is now at 71, officially overbought. The weekly MACD line separation is wide, but the histogram bars are no longer accelerating at the same rate, they're plateauing. That's your first hint of momentum deceleration now. The daily chart, the one that drives our trades. The Nikkei closed at 65,158, well above every major daily moving average. The 5-day average sits at 63,472, the 10-day at 62,568, the 20-day at 61,765, the 50-day at 59,609. Look at those gaps. Price is trading almost 4,000 points above its 50-day moving average. That is an extreme dispersion that historically mean reverts, at least partially, within 5 to 7 sessions. The daily RSI is 68.53, and here's what most traders miss. An RSI reading of 68.5 on a daily chart in a strong bull market is not an automatic sell signal. It's an indication that the trend has energy. But combined with a price extension 4,000 points above the mean, it creates a coiled spring. The MACD on the daily is printing a colossal 1.36 million value, which confirms momentum but also signals that reversion pressure is building underneath. Drop to the 4-hour and 60-minute charts and the picture is all strong buy, which means intraday pullbacks are being bought aggressively. The 5-hour moving average at 63,472 is the nearest dynamic support on this time frame, and it held perfectly during the Asian session consolidation before the latest leg higher. The key levels you need to drill into. Your head are these. Immediate resistance. There isn't any on the chart because we are in blue sky territory, but the measured move target from the breakout above the 64,087 zone points to 66,300. That's based on the width of the prior range added to the breakout point. Psychological resistance arrives at 65,500 and then 66,000 even. On the support side, 64,087 is the breakout level, with 64,043 as the lower boundary of that zone. Below that, 63,946 and 63,902 are the hard supports. If we lose 63,902, the entire breakout narrative collapses. Before we get to the trade setups, we need to talk about the invisible hand that could slap this rally into reverse, the Bank of Japan intervention ghost and the yield differential drama. The Nikkei's 3% surge didn't happen in isolation. It was matched by a yen slide, with dollar-yen pushing toward the 160 zone, and JGB yields remaining pinned by the BOJ's yield curve control shadow. Japanese exporters are priced for perfection when the yen is weakening, and that's the fuel behind this rally. But here's the cross-asset linkage that most equity-only traders ignore. Every time dollar-yen approaches a big figure with velocity, the probability of a BOJ rate check or outright intervention spikes exponentially. The last 3 interventions occurred when yen depreciation accelerated beyond 2% in a single week. Right now, dollar-yen is up 1.8% this week, and Tokyo officials have already used the phrase excessive speculation in off-session comments. If the BOJ intervenes, even a small one, the yen could snap 2 figures lower in dollar-yen within minutes. That move would translate into a 3 to 5% Nikkei flush, because the correlation between yen strength and Nikkei weakness is running at negative 0.85 over the past 20 sessions. The market is a tightly wound pair trade. So when you hold a Nikkei long right now, you are implicitly short the yen and betting the BOJ stays passive. That bet has a time limit, and the pressure gauge is rising. The 1 to 2 week directional lean remains bullish as long as 63,946 holds, but we are in the final stage of momentum extension, not the beginning. The event that would invalidate the bullish thesis entirely is a dollar-yen daily close below 155, or a BOJ emergency meeting leak. Until that happens, the path of least resistance is still higher, but the risk-reward of chasing at 65,000 is poor. We need surgical entries. Now we move into the trade setups. Most people will skip this section because they've already heard the narrative they wanted, and will jump into a position with no plan. But this is where money is made. Keep watching, because I'm going to give you 3 completely different attack strategies, each with exact trigger prices, stop losses, and reward maps. And after strategy 2, I want you to drop your Nikkei high-low range for tomorrow in the comments. I'm reading them, and it shows me how aligned this community really is. Strategy 1, the sniper, conservative approach. This is for traders who want to wait for confirmation that the breakout is not a trap and are willing to sacrifice the first 20 to 30 points of a move for higher probability. The trigger condition is a 4-hour candle close above 65,500. That level represents a clean break of the immediate psychological hurdle and creates a higher high on the 4-hour chart that would force algo buying. Your stop loss goes at 64,800, exactly 30 pips below the Friday pivot high that was taken out today. That placement respects the breakout structure. If price rotates back below that level, the momentum is broken. Target 1 is 66,000. Target 2 66,300. The risk-reward on this trade is roughly 1 to 3.3, well within institutional parameters. What voids the setup is any reversal below 65,100 within the first hour of entry, or a sudden dollar-yen drop of more than 50 pips that signals intervention speculation. If that happens, scratch the trade. Strategy 2, the active trader, standard approach. You're not waiting for the breakout confirmation. You're playing the retest of the newly converted support. Entry condition is a pullback into the 64,200 to 64,100 zone. That's the top of the prior range that should now act as support, and it coincides with a mean reversion towards the 5-hour moving average, which is currently rising at 63,472 but will be nearer 64,000 by the time price potentially dips. So set your limit order at 64,150. With a stop loss at 63,880, just below the 63,902 hard support. That gives you a 270-point stop. Target 1 is 65,500. Target 2 is 66,000. Once target 1 is hit, immediately move your stop to break even plus 50 points and trail it with a 50-point buffer behind each subsequent 100-point advance. This protects the profit while letting you ride the trend. After you hit target 1, leave a runner for target 2 but never let a winning position become a loser. The risk reward here is 1 to 5 if both targets are captured, but even target 1 alone delivers a solid 1 to 2. Now let's see how aligned we are. Type your Nikkei 225 high-low range for tomorrow in the comments right now. I want to see what this community expects, 65.5 to 66, or maybe a reversal back to 64. Drop the numbers. I'm reading every single one, and tomorrow's video will reference the consensus, strategy 3, the aggressor, high risk. This is for those who believe the intervention ghost is about to materialize and want to fade the spike. You're looking for a blow-off top on the 5-minute chart above 65,500 that gets violently rejected, with a wick of at least 200 points and a closing print back below 65,200. That's your entry trigger. Short at market after that candle closes, with a tight stop at the high of the wick plus 20 points, typically around 65,700. Target 1 is the breakout zone at 64,087. Target 2 is the 63,946 structural support. This is a counter-trend trade that attempts to capture the intervention unwind or the inevitable reversion. The risk is roughly 200 points against a potential reward of 1,000 points to target 1 and 1,400 to target 2. But I have to give you the explicit warning. This setup only works for those who know how to lose small and manage risk aggressively. The trend is still up, and you are standing in front of a freight train. If the BOJ stays quiet and the yen continues to weaken, this short will be run over. Position size accordingly, half your normal risk, or less risk management pulse. Never risk more than 1 to 2% of your account on any single trade. No position should be held through a BOJ policy statement or unscheduled announcement. Stops are not suggestions. They are the only thing separating a calculated loss from a career-ending drawdown. If you get stopped out, the market gave you information. Respect it. Here's the close and your retention loop. The one most critical level for the next session is 63,946. As long as the Nikkei remains above that number, the bulls own this tape and dips are for buying. A daily close below that level flips the script and opens the trapdoor towards the 50-day moving average at 59,600. Tomorrow I'll be dialing in on the dollar-yen chart because that pair is coiled for an explosion, and the Nikkei will follow whichever direction the yen breaks. If you want the full breakdown on Bitcoin and the S&P divergence, that video is live now. Check the end screen. Smash like if this analysis gave you a clear plan. Subscribe and hit the bell for daily coverage across all 8 institutional grade assets. I'll see you in the next one.